Starting. Hello, thank you for tuning in to this episode of the Creativepreneur Podcast. I am very excited because today I am going to be chatting with James Conole, the owner of Root Financial Partners. James is a certified financial planner and also has his MBA. He serves as a fiduciary for small business owners and individuals, helping them with financial planning and investment management. Hi, James.
Hey, Braden, how's it going?
I'm well. How are you?
I'm doing great. Thanks for having me.
Yeah, thanks for being here. I'm really excited because I know that a lot of my audience isn't super comfortable with finances. And of course, I know that because I help them with their taxes and their bookkeeping. Financial planning is not something that I really do. So I'll give people some tax guidance on things like IRAs, but I don't really tell them what type of accounts to be investing in. So that's where you come into this whole situation.
Well, then we've got a good topic for today. I like it.
Perfect. Okay. So why don't you just tell us a little bit about your background? So maybe like where you went to school, what you studied, and how you got into what it is that you do.
Absolutely. So I think I'm maybe in some ways very much like your audience, but I actually love finances and love the kind of the planning side of things. I think I grew up very much drawn to things that required critical thinking or planning or kind of the number type stuff. And I knew growing up that's what I enjoyed doing, but I don't think it was until I began studying finance and then began interning really with financial planning firms that I fell in love with this profession in particular. And what I love about it is that I get to use numbers and money and problem solving, but not just for the sake of crunching numbers, but I really get to do it in a way that helps support people's dreams and really helps people accomplish what's most important to them, right? Money in of itself has no value. The value is the ways in which we can use money to help someone prepare to send their kids to college, or help someone plan to retire comfortably, or help someone buy that home that they've always wanted to purchase. So that's what my background with this profession was just falling in love with the ability to use money and use critical thinking and planning skills to help people accomplish what's important to them. So I studied finance, studied business at Pepperdine University, then went on to get my MBA at Pepperdine University with a concentration in finance. And I was just lucky enough to find an internship with a couple of firms throughout college within the financial planning field. And one of those firms happened to be growing as I was interning for them. And it just worked out to where I said, look, I'm graduating in a year. I love this profession. I love this company. If you need someone like me when I graduate, I'd love to work here. So it just really naturally and organically fell into my lap, really. And I haven't looked back. So I think that was 7.5 years ago or so. And been doing it since then and hope to do it for a long, long time to come.
Nice. Yeah. So I was actually like in college interested in this topic as well, but I took a finance class and then quickly learned that it was not actually personal finance. And I don't know if other people who are listening will relate to that, but it's like from an academic standpoint, it's an entirely different thing, doing finance for large businesses versus what we're doing, helping individuals with their personal finances.
Absolutely. Absolutely. It's all finance, but it's very different avenues of finance, I would say.
Yes, exactly. Okay. So tell me, I was curious. I always like to ask people kind of what their financial philosophy is. And I know that's kind of an abstract, ambiguous question, but what would you say is your financial philosophy when you're talking to individuals?
I think it starts, so there's two parts to this. And I think it starts with a little bit of what I just mentioned. And the fact that when we're doing financial planning, we really need to understand, what are we doing this for? We're not just investing to invest. We're not just saving taxes to save on taxes. We're doing it because it ultimately supports something bigger in our lives. It supports what we truly care about in our lives. And so I think it starts with that, which is understanding money is simply a tool to help us accomplish what's important to us. Now, beyond that, I like to think of myself almost like a personal trainer, right? You might think, if you're going to a personal trainer and say, oh, what's the best workout routine to use? Well, the best workout routine is whatever one you're going to stick with, right? And so there's not just one way to get in great shape. And similarly, there's not just one way to have success financially. So I view my job as getting to know my clients, getting to know them really well, getting to know their personality, what works for them, what doesn't work for them, so we can really custom design a plan for them that they're not just going to see and say, this looks great on paper, but something they can actually stick with, something that fits with who they are and what their personality is, so that as we're planning for whatever goals they have, we have something with some lasting power that they're going to stick with over time. So it comes down to, what are we using money for? And then how do we plan in such a way that fits whoever it is we're working with?
Yeah, so that's kind of a good segue, because I wanted to mention one of the reasons why I was really excited to have you on this podcast is because I have now been looking for a little while in San Diego for a fiduciary financial planner who would speak well to my ideal client and my audience base, which is
Right.
mostly creative-based entrepreneurs ages 25 to 40. And most of the people who end up becoming fiduciaries have been in the business for a while. They tend to be older. Could you tell my audience a little bit about what it means to be a fiduciary versus the alternative to that in your industry?
Yeah, absolutely. I think the bottom line is, a fiduciary is legally required to put their client's best interest ahead of their own. Even if that means they make less money or no money for giving a recommendation, they are legally required to put their client's interest ahead of their own. And you would think, okay, well, James, that's a no-brainer. I'd hope my planner, I would hope my CPA, or hope my attorney would put my best interest ahead of my own. But in the advisory industry, in the industry I'm in, a lot of people aren't technically fiduciaries. And if they're not fiduciaries, they're just brokers, or they're salespeople. They're seen as sales representatives of their firm. And so they're not required to put their client's best interest first. They're just required to do something that's quote unquote suitable for that client. And Braden, what's suitable for you may not necessarily be what's in your best interest. And from a practical perspective, what that means is, a fiduciary cannot accept commissions, can't accept kickbacks, can't accept payment from the product company that they're recommending to their clients. They only get paid by their clients. And why that's important is, if you're my client and you say, hey, James, I need to invest my money. And I say, okay, well, there's these 4 or 5 places you can invest it. If I'm not a fiduciary, I might choose one of those places that pays me the most money without really caring so much about, okay, well, which of these is actually best for Braden. So it's simply a way of putting clients' best interest first instead of putting the advisor's interest first.
Right. So like, as an attorney, I'm a fiduciary for my clients. It's super important. And then CPAs have the same type of relationship. When it comes to financial planners, what happens is, a lot of the financial planners I meet work for larger companies, and what they're doing, and I'm not going to mention anyone in particular, but if I go to talk to them about my finances, it's more about them trying to sell me life insurance and disability insurance and these types of things, rather than weighing all of the options and say, this is what's going to be in your best interest. And of course, there's nothing wrong with people who do those types of things, because you probably need those things anyhow. But the point being, if you go see an independent fiduciary, their responsibility is not to the company into making money on these products, but rather to weigh all the benefits and costs for your individual circumstance. So
Exactly.
The fiduciary, I know, just from looking into it myself, that you'll charge consultation fees and stuff like that. So without really looking into it, if I go to talk to a financial planner, I want to find someone who I can just pay a set amount of money in order to give advice from them.
Mm-hmm. Exactly. It typically comes in one of 2 forms, and usually there's some sort of free consultation up front, just kind of get an idea, of course, what the client's looking for. But it can come in the form of, you simply pay a fee to say, look, this is the financial planning work I want to do together. Either here's a one-time fee, or kind of called a retainer fee for ongoing work together. Or it's, hey, here's some investments that I have. Charge me a fixed fee, or at least a fixed percentage for managing these investments. But the difference is, it's very transparent, and you are the one paying it to compensate the advisor for their fiduciary guidance. You're not being sold an insurance product or an investment product that's got layers and layers of fees, being told, oh, there's really no fees. It's transparent, and the advisor doing it is required to do what's in your best interest, which is the important part.
Yeah, I think it might also just be because I'm a cynic at heart, but anytime I hear the words free consultation, I immediately think, well, what are you trying to sell me at the end of the consultation?
Exactly.
So that's why I actually, when I'm seeking legal professionals, but any sort of professional guidance, I just like to pay people consultation rates. So that's kind of my perspective on financial planning and what James is doing over at Root Financial Partners. Just wanted to give some context as to your business model and how you might differentiate from some other people that we may have met at, other outings.
Absolutely.
Okay, so what we're really diving in today on is retirement planning. So this is something I know I don't really like to think about because it's terrifying. We have all been in a presentation at some point that they say like, oh, if you need X million dollars for retirement based on all these calculations, you should have started saving 10 years ago. And then we just bury our head in the sand and keep dragging our feet on it. But obviously we all have to bite the bullet at some point and start doing some planning. So let's just dive in. Why don't you tell us kind of the reason why we really need to start thinking about this now?
Absolutely. Well, the reason is, I think a lot of your audience and really a lot of my clients, they're passionate about the work they do and they love the work that they do. But what we're ultimately trying to create is that sense of financial freedom. And financial freedom is the point at life in which if you love what you do and you're passionate about what you do and you're still able-bodied enough to do what you do, then by all means, keep doing it. But we do need to prepare for a time when either because we no longer are physically able to do something or we just simply can't continue working, we need to be in a position where we've got enough money in savings and investments that we can fully support ourselves even if we don't have a paycheck coming in from the day job that we have or even the business that we've created. So retirement planning is simply a way of saying, what do we need to begin doing today to support whatever lifestyle you want to have in retirement? You know, some people it's just, I just want to live comfortably and have a very simple retirement. Other people, it's James, I want to travel the world and I want to live a very lavish retirement. So it's kind of the way of saying, okay, what do we need to be doing today in order to start taking steps to accomplish those goals down the road? And the exciting thing, Braden, is as overwhelming as it can be and as scary, I think, as it can be to think about retirement planning, when you look at something called compound interest and starting early and just doing the little things right as early on as possible, it can make a huge difference over time. When people see that, I think it becomes something that's not as scary as it once was, and it actually becomes really empowering when they can say, oh, wow, if I just do these things, this is what my future can look like down the road. And where I think we're going with some of this is most people, they ask the question, okay, how do I begin retirement planning, right? If I'm a business owner or a solopreneur or whatever it is, what are my options really to begin planning for some of these things? And so I know we'll talk about some of this, but that's the real goal is to support your lifestyle down the road when you're either no longer able to or just quite frankly don't want to work anymore.
Gotcha. So obviously to save money, and then also I, of course, as a tax attorney, have to mention that retirement planning can save you on your taxes come tax time. So that's an added benefit as well and something we'll talk about.
Absolutely.
Okay. So we know we all really have a sense of why we need to save for retirement. I, of course, would encourage everyone to sit down with you one-on-one to see how compound interest truly works, because it's pretty miraculous when you see it in graph form. But when do you think we all should start considering doing our retirement planning? Like, when do we need to start it?
I'm sorry, Braden, say that one more time. I think I just cut out a little bit.
Oh, no problem. So I just asked, when would you recommend that we all start looking into doing our retirement planning?
Yes, good question. The easy answer is as soon as possible. And that might necessarily mean, hey, it's time to set up a retirement plan. But to your point, when you start compounding money over time, it makes a huge difference. But in general, when a business owner is trying to think, okay, how do I start planning for retirement? It's typically when they're starting to make a good amount of income, right? If you're just starting and you're a year in, a couple years in, 3 years in, and you're making ends meet and you're doing okay, but you're really not, you don't have much excess money or you feel like the business still has a lot of room to grow, that may not be the most necessary time to begin planning. The priority at that point may be, how do we get to the business to a point where income is higher so that we can begin doing some retirement planning. But once your income's a little bit higher and once you start paying a lot more in taxes, as that's, of course, what happens when your income goes up, when your income is high and you're starting to pay a lot more in taxes, that's where setting up a retirement plan can be very beneficial. And now I think, some people may have heard the term traditional IRA. It just stands for individual retirement account. So when your business owner is looking at this, whether they're a business owner or just an individual, anyone can put money into a traditional IRA. and you can put up to $6,000 per year, we're talking about 2019 numbers, into a traditional IRA. And so what that means, Braden, is if my income's $100,000 and I put $6,000 into a traditional IRA, well, I get the dual benefit. Number one, I'm actually only paying taxes, federal and state taxes, on $94,000. Meaning I earned $100,000, but because I put $6,000 into an IRA, I'm only paying taxes on $94,000. Now that money also grows for me, which is a benefit. So once I'm at that point, the traditional IRA is often the first place I want to look. If I'm just looking at it, what's the easy way to save money on taxes and save for retirement? But as your income even goes above just the need to save $6,000 to an IRA, that's where there's a lot of other retirement plan options that are available.
Makes sense. So this is why I tell a lot of my clients, they're at the end of the year, they want to reduce their taxes. It's December, let's say it's December. I talked to someone last year who's like, oh, I'm going to buy a new computer, so I can get a deduction. Because if I buy a $1,000 computer, then I can save $1,000 in taxes. And I was like, okay, no, that's not how tax deductions work. It's not a dollar for dollar benefit. It just reduces your taxable income.
Right.
And I have actually already done an entire podcast on this, so people can go listen to it. But this is why I say invest in your business if you need that computer for your business. But if there's not anything that you really need and you want to lower your tax bill, put the money in the IRA.
Exactly. And I think that's a good point you made, Braden. Yes, it's not a dollar for dollar reduction. If your tax bill is $5,000 and you pay $5,000 for a new computer, put $5,000 to an IRA, you're exactly right. I think that's a mistake some people make. It doesn't reduce your taxes dollar for dollar. It reduces your taxable income, meaning it reduces.
So the way I explain it is, say you have $100,000 of income and then you put $10,000. I know you can only do 6, but for math, let's say 10,000 into an IRA, you get a $10,000 deduction. Assume there's a 10% flat tax. Before you put the money into the IRA, you're paying $10,000 in taxes. After you put the money into the IRA, you're paying $9,000 in taxes.
Exactly.
So you've invested $10,000 and saved $1,000 in taxes, and that's how the math works out. So that's how you should look at business deductions as well. So if you're going to buy a $10,000 computer, let's use an extreme example, then you would look at it as you're spending $9,000 for something that costs $10,000. So you're really getting like $1,000 discount on the item. Mm-hmm. That's how I always explain like investing in your business for tax deductions. So exactly. I tell people, if you didn't need that computer, then you just threw $9,000 down the trash. You should have put that in your IRA instead.
Exactly. And to your point, you can't put $10,000 into an IRA, but for simple math, they see that. But there are other types of retirement plans you can set up.
Yes.
I want to clarify one thing real quick. So, because I think I don't want to confuse the audience. There's retirement planning, which to me is just simply the process of putting a plan in place to accomplish retirement goals. Right? It's what things do I need to be doing? I giving someone a clear path from where they are today to where they want to be in the future. That's retirement planning. When we're talking about retirement plans, those are specific account types that they can set up as business owners to save taxes and save their money in. So sorry for that aside. I just want to make sure that people aren't confused because they're very similar, but I want to kind of clarify that for them.
Oh no, that's a really, really great point. So it's one of those things. It's like, I'm going to educate you on an S corporation right now, knowing that you might not be ready for it until 3 years from now, because that's planning.
Exactly.
So it makes sense. I can hire you to do retirement planning. That doesn't necessarily mean that we're going to open a retirement plan right now.
Exactly.
Makes sense. Okay. So I did have kind of one hypothetical I wanted to run by you before we really dive into the different types of plans. Let's say, for example, because I know that this is probably going to be pretty similar for a lot of my listeners. Let's say that I may be in my second year of business. Business is picking up. I'm starting to get a fair amount of clients. I'm like paying my bills okay. I have a little bit of extra money. I'm paying my taxes. But I have, let's say, 10 grand at the end of the year left over, or 5 grand. Mm-hmm. What would you say if I were to ask you, would it be better for me to hire a business coach to really up-level my business in my third year and quickly generate more profit? Or should I go ahead and start looking into a retirement plan so I can get that compound interest rolling?
Yeah, great question. And it's a really good question because ultimately for a lot of business owners, their business is going to be the primary wealth building vehicle they have in their life, right? The more they can grow their business, the more they'll have an income each year to ultimately save for retirement. So I think as business owners, I always tell them, look, it's not your retirement plan's job to make you rich. It's your job to really grow your income and get you to a point where you can get there. Your IRAs and the retirement planning you do, that's just simply a way to take some of what you've earned and set it aside for the future so that it can begin growing for you so that you can use it down the road. So I think in those first couple years, let's say back to your example, Braden, if you're in your second year and you're doing okay with income, I would probably say hire a business coach. Because if you're doing okay with income, you may not need a huge tax deduction. I mean, if income's okay, but it's not incredibly high at that point, you may not need to make a tax deductible contribution to a retirement plan because taxes may not be that high to start with. So the better thing to do may be hire that business coach, allow them to help you get to a point where business is really thriving. And then next year and the year after and the years after that, you'll have a lot more income that you can save to retirement plans. So it's not, I guess, not as cut and dry as other things are, but I think it's a good point. And I would actually encourage people to invest in their business in the first couple of years so that in the latter years, they can focus on retirement planning.
Nice. Yeah, that makes a lot of sense because I'm kind of over here thinking that if I'm making like 60,000 this year and my goal is to get to six figures as quick as I can, and I spend $10,000 on business expenses, to make another 40, another 50, that growth in my business is going to outpace any kind of investment I'm going to get, unless I'd invested in cryptocurrency like 4 years ago.
Exactly. And then it'd be back to nothing today. But yeah,
right,
you're exactly right. The return on investment with your business that potential is far greater than it could be with a retirement account or an IRA or whatever it is.
Beautiful. So really the takeaway that I would have from this little piece of the conversation is obviously not that this is the approach everyone should take because it's different for everybody. You need to talk to a professional, but just make sure you're balancing retirement plans along with your business because they're both investments.
Exactly. And all that, if someone's 25-year-old is 25 years old and asking that question, it's a whole lot different than someone who's 60 years old and asking that question. Right?
Sure. Yeah.
If you're 60, you need to play some major catch up, then, I'm sorry, but we need to make sure that you're putting some money away so that you can retire in a few years. Well, if you're 25 and asking this question, look, invest in the business, maybe put a little bit away, but focus on growing your business because you've got years and years ahead of you for that business to really provide dividends to you and create the income that will allow for some of these other goals.
Totally. Okay. Awesome. So we talked about why you need to have a retirement plan and kind of when you should start thinking about retirement planning. Well, really, you should start thinking about retirement planning right now. We talked about when you should maybe open a plan. We clarified that. Let's dive into the different types of plans. So just give us like a broad overview of what the offerings are out there.
Yeah. So as we just mentioned, the basic offerings are traditional IRAs and Roth IRAs. We didn't really touch much on Roths, but a traditional IRA, whether you're a business owner or even anyone can open one and you can put up to $6,000 per year into it. If you're over 50, you can put a little bit more, but you can put $6,000 in. If you own a business and you're saying, okay, James, that's great. I put $6,000 in, but I still need to save more on taxes, or I still want to be able to save more for retirement. Then there are other types of retirement plans that you can set up for your business. The first one is called a simple IRA. With the simple IRA, instead of just being able to save $6,000 per year, you can actually save $13,000 per year to your retirement account, to your simple IRA. So it more than doubles the amount that you can deduct from your taxes by making a contribution to your simple IRA. Now, the one thing I want people to keep in mind is if they're a business owner and it's just them, there's no employees, they can make that $13,000 contribution plus make a match themselves, and it's very straightforward and very easy. If someone has employees, though, they just need to keep in mind that as an employer, they're going to be required to make matching contributions to employees. So say, Braden, you got an employee with you, you got a couple employees, and you set up a simple IRA for yourself. Well, you can put $13,000 per year of your own money into the simple IRA. Your employees can do the same, but then as a business owner, you're either going to have to match 2% or 3%. There's different formulas, but keep in mind probably somewhere between 2 or 3% to your employees if they're making contributions to their account. So there's a little
And
bit.
do you need a particular form of business entity to do that, or could you do it as a sole proprietor?
You can do this as any entity. If you're a sole proprietor,
Okay.
now the way you calculate income and stuff like that on the tax side is different, but the retirement plan contribution limits remain the exact same. Whether you're an S corp, sole proprietor, LLC, doesn't matter for this.
And I'm going to tell everyone, do not hire any employees until you at least have an LLC. But if you've already done that, you can use the simple IRA as the sole proprietor if you have employees. So that's awesome. So I could do $13,000 and then match it, so that I'm saving $26,000 a year into my simple IRA and getting a $26,000 deduction.
So you couldn't you can't necessarily do a $13,000 match. The match is either going to be 2 or 3% most likely of your income. So say, Brady, you're making $100,000. Again, let's just use that round number, and you put $13,000 into your simple IRA. Well, then the business, in addition to that, so the 13% or the $13,000, that's considered your employee deferral. So you, as an employee of your business, can put in $13,000. Now, you, as the owner of the business, will match 2 or 3% of your total income, which is $100,000. Which means you'll put in another $2,000 to $3,000 in addition to that. If that makes sense.
And that would be, when you say 2 to 3% of my income, that would be my salary in the business, correct?
Exactly.
Not the business income.
Correct. Of the salary that you take. Mm-hmm. Because think of it as your business is matching what they paid Braden as an employee of your business, 2 or 3% of his income, depending upon the formula you choose when you set it up.
Gotcha. Okay. Awesome. So that's the simple IRA. Other than those matching benefits and the higher contribution amount, are there other benefits to a simple IRA over a Roth or a traditional IRA?
The benefit is really just the higher contribution limit. You can contribute more than you can put into a traditional IRA. The benefit of a simple IRA versus some of the other plan types we're about to talk about is that a simple IRA is pretty easy to administer. We're going to talk about 401ks in a second. There's something called defined benefit plan when income gets really high. But a simple IRA is very easy to administer. There's typically no setup costs. There's not really any government compliance testing, or at least to a much lesser extent there is. When you get into other plan types, and we'll kind of touch upon this in a second, there's a lot of compliance and administration testing that goes on to ensure that these plans aren't discriminating against lower salaried employees. With the simple IRA, it's much easier. You're not paying $2,000, $3,000, $4,000, $5,000 a year for a separate company to kind of manage that compliance for you.
Gotcha. So would you say the appropriate time to think about a simple IRA is basically just when you're ready to start saving more than $6,000?
Yeah, I would almost work backwards to say, how much do you want to save for retirement this year? If the number is $6,000 or less, well, easy. Use a traditional IRA and that's done. If the number is between $6,000 and $13,000, okay, well, then a simple IRA is probably best for you. If you want to save over $13,000 per year, then you'll probably want to use something different, like a SEP or a 401k, which we'll cover in just a second. But yes, you almost work backwards to calculate it. What amount do you want to save for retirement? And then kind of choose the retirement plan that fits within those limits.
Awesome. Okay, so did we talk about the benefit of the Roth IRA?
Or we didn't. We skipped over that a little bit. Do you want me to kind of elaborate on that?
Yeah, go ahead and explain what the difference is between that and the traditional. And I'll go ahead and tell people that for the first while, I had to Google this like pretty much every time because I forgot which was which. But the important thing is just to know the benefit of what I call, quote unquote, the special one.
Exactly. I'll talk about the special one now. So with a traditional IRA, the benefit for you is it reduces your taxes today. So again, back to our example. You make $100,000. You save $5,000 to a traditional IRA. Well, you're only paying federal and state taxes this year on $95,000. You don't pay taxes, at least income taxes, on the amount that you save to a traditional IRA. Now, where the IRS gets you is they're going to allow that money to continue growing tax-free for you, but when you're retired and it's time to live on that money, they're going to tax it on the way out. So you get a tax deduction for putting money in an IRA, but you pay taxes when you pull that money out of your IRA in retirement. Does that make sense? Mm-hmm. A Roth IRA is almost the exact opposite. Any money you put into a Roth IRA, you don't actually get any tax breaks today. So if you make $100,000 and put $5,000 in a Roth IRA, well, you still pay taxes on the full $100,000. It doesn't actually help you from a tax perspective today. The benefit is that money will grow tax-free each year. And then when you pull that money out in retirement, it's completely tax-free as well. So that's why I say when people are just getting started or have relatively low incomes, a Roth IRA actually usually makes a whole lot more sense, because there's not, if they're not paying much in taxes anyways, well, then why put money into a traditional IRA if your tax benefit's not going to, it's not going to benefit you much from a tax perspective because you're not paying much in taxes anyways, only to have to pay taxes on that money again when it comes out in retirement. Might as well put money in a Roth IRA if you're in a low income tax bracket, so it grows tax-free forever and comes out tax-free in retirement when you may be in a higher tax bracket.
Makes sense. So I've always thought the Roth IRAs were kind of like magic. And it took me a long time to understand.
Magic, Braden.
Yeah. It took me a long time to understand when you wouldn't necessarily want a Roth IRA. And I think I know the answer to that question. But you tell me if there's any circumstance when you wouldn't want to use a Roth IRA, and we'll test my intuition on it.
So I love Roth IRAs, and I encourage people to use them as much as possible because it's essentially hedging against taxes in the future. Now, when you wouldn't use a Roth IRA is if you really needed that tax savings. So you're in a higher tax bracket, 25, 30, 35, 40%, whatever it is. When taxes are becoming a real problem and you need a way to reduce taxes today, well, a Roth IRA is not going to help with that. It's a way to not pay taxes in the future. But if you're looking for a current year tax deduction, that's where an IRA would help, or a simple IRA or some of these other types that we're talking about.
Gotcha. Yeah. Because I was just thinking it might make sense if you're making a lot of money right now and you want the tax deduction and you're planning on retiring and making very little money in retirement. But then you're hedging your bets because you don't know what tax rates are going to be under, whatever Congress we have in 2060.
Well, that's exactly right. It comes down to, are you going to pay tax more? Are you in a higher tax bracket today or in the future? And we don't know where taxes are going to be in the future. But if you take an educated guess, if you're paying lower taxes today, well, then use a Roth. If you're paying higher taxes today than you will in the future when you're retired, then probably best to use an IRA or one of these other retirement plans we're talking about today.
Yeah. The other explanation I like is I always think about this in terms of capital gains. So this is like, if you spend $10,000 on stocks and then you sell them next year for $20,000, you made $10,000. And the IRS is going to tax you on that. On your capital gain. And that's really the same way that retirement earnings work on a traditional IRA. You get the deduction now, but then you're taxed on whatever your gain is. And the reason why the Roth IRA is amazing is because it's, to my knowledge, there might be others, but to my knowledge, it's the only way that you can really invest now and then not have to pay tax on all of those gains you're getting over all the years and years, which is really pretty phenomenal when you think about it.
It is. And that's why, like I said, I love it. And I encourage people to use it as much as possible. The only downside is, like we said, it doesn't give a tax benefit today, but it's got some huge tax benefits over time.
Right. Okay. So we talked about traditional IRA and Roth IRA and simple IRA. And I think all those are pretty simple to understand. Ba-da-bum. Not all the jokes are going to land, and that's okay.
Yeah,
okay. So what's the next plan we should talk about?
So if you're making too much for I shouldn't say making too much, but if you want to be able to defer more than $13,000 into a retirement account, the simple IRA is probably not best for you. It's going to be capped at $13,000 plus whatever the employer matches. But if you want to do significantly more, then you have what's called a SEP IRA, SEP, so SEP IRA. And with a SEP IRA, the contribution limit for 2019 is $56,000. Now, there's certain income thresholds you need to hit, meaning you're limited to 25% of your income to do this. And I'll touch upon that again in just a second. But it allows you to make a much larger contribution to your retirement account. So if you're making, $400,000, $500,000, let's say you're making $500,000, you're going to be in a pretty high tax bracket. So one way to get your taxes down is to say, okay, well, of this $500,000 I'm making, I'm going to put $56,000 into a SEP IRA. And now, instead of being taxed on $500,000, you're being taxed on, what was that, $444,000. So it's going to drive your taxes down quite a bit. And that's the benefit of a SEP, is you can just put a whole lot more money into your SEP IRA.
So it's the lesser of $56,000 or 25% of your income?
Correct. And that's a good
Okay.
point, because if you're making 100 grand, Braden, and this also depends on, are you a sole proprietor or are you an S corp? So these numbers aren't exact, but I'm going to use the numbers 25%. You're limited to putting 25% of the income you take as a wage into your SEP IRA. So if you pay yourself a wage of $100,000 from your S corp, well, then your max SEP contribution for that year is going to be 25,000. That makes
Yes. It does. It does. And I'm actually going to be doing a full episode on S Corps. So we can kind of tie that in with a nice bow when I talk about salary versus distribution and S Corporation. But that's a really good point because I would presume that most people making $100,000 are not going to want to invest $25,000. But if you are married, then maybe you're going to want to do that. If you have a high income earning spouse or something, there are lots of different circumstances. So I know, like, when I Googled these I'm so, professional. When I Googled all these retirement plans, I determined that the SEP IRA was probably what I was going to want to do. But what's the drawback to doing that over the simple IRA? Is it more expensive to maintain?
There's no, it's the same cost to maintain. I mean, there's typically no cost to set it up. The drawback is if you have employees and you're using a SEP IRA, then whatever percentage of your income as a business owner you contribute to your account, you have to make the same percentage contribution to employees. So let's say,
Gotcha.
again, using the example, you make $100,000 and you contribute, let's say 20% to your SEP IRA. So you're paying yourself $20,000 and that's going into your SEP IRA. Great. Well, now what you need to do is, let's say you're paying an employee $50,000 per year. You need to make a 20% contribution of their salary to their SEP IRA as well. So
That's a
now all
lot.
of a sudden, that's a $10,000 contribution, and whatever you saved in taxes is probably wiped out by the expense it cost you to make an employee contribution. So while they can be great in kind of retirement plans for people who are in business by themselves and don't have employees, it's almost never a good plan to have when you have multiple employees, unless you're trying to pay out a whole bunch of money to people.
Makes sense. So does the SEP stand for self-employed?
It doesn't stand for self-employed. What does it stand for? Simple something employee pension or something like that.
Okay. Let's just pretend like it stands for self-employed, and then it's
Let's
easy to
do that.
remember.
Yeah,
So
we'll
that's
make it
when
their
you're
own
a
rules.
Okay. So then simple IRA, SEP IRA, simple was 13,000, SEP 56,000 or 25% of income. What's the next plan we want to chat about? And I think we have like 2 more of these. So don't worry that we're going to go through a laundry list of 20 of these things.
Yeah, we got 2 more. And do you want me to, and let me know if you want me to kind of keep this a little bit shorter. But the next,
Yeah. Let's keep in mind that I really think that a large majority of my audience is probably under 200K. A lot are probably under 6 figures. So the ones that are really for higher income, we can keep more brief.
Perfect. Well, let's keep it brief, and I'll kind of say, of all these plans, I'll say which one do you probably need to look at, because a couple of these are the ones I'm using most of the time, especially for that type of income range. The next one is a 401k, and again, very different if it's a 401k for a solo business owner with no employees versus someone with a lot of business owners. Now, the 401k in many ways is like the SEP IRA, where you can put up to $56,000 per year. So it's just going to give you a lot more room to contribute than a traditional IRA or simple IRA. The bottom line with this, though, is you don't have to show as much income to get money into a 401k as you do with a SEP IRA. So for example, we just said with the SEP IRA, you're limited to 25% of your income. So if you wanted to get $50,000 contributed to that, well, you would need to show $200,000 of income, because 25% of that is $50,000. With a 401k, you could make the same large contributions without having to make as much income. And I'll kind of spare the audience the way that's calculated, but just keep in mind it's a way to contribute a lot of money to your retirement plan if you want to, without having to earn 250 grand to justify those contributions.
So then I'm assuming there's got to be some other benefit the SEP IRA has that the 401k doesn't have, or everyone would just go for that one, right?
Quite honestly, Braden, I was talking with another advisor a week ago, and I said, why would you use a SEP IRA instead of a 401k? And I guess it's a little bit easier to set up, but there's really not a huge benefit. Now, some custodians will charge you a fee to set up a solo 401k, but there's a lot that don't, a lot of really good custodians that don't. So if they don't, there's really not any benefit to do a SEP IRA over a 401k, except for the fact that it's just super easy to set up. But if you want to take the extra 10, 15 minutes to get a 401k set up, it actually gives you everything the SEP has plus some added flexibility.
Interesting. Okay. So knowing that, I know there was one other one, the defined benefit plan, and I know that's for higher income people. Is there anything we really need to know about that one?
No, if you're listening to this and saying, no, this is great, but I want to save way more than 56,000, just know there's something called a defined benefit plan that could help with that. Call me if you have questions, but we don't need to go on today's call. I think it's
honestly,
probably,
if you get to the point where you are even growing out of the traditional IRA, then it's definitely time to get a financial planner. And I would say even before that.
right.
But yeah, if you want to contribute more than 56,000, then you need to go talk to anybody anyhow.
Exactly. Exactly. I'm using those for my very high income clients, but most of the time we're not using defined benefit plans for your average everyday kind of retirement plan.
Perfect. We'll all earmark it as a goal to grow into.
Perfect.
Okay. So I do have a couple questions. So if we wanted to, so I know helping people with taxes, kind of the repercussions of wanting to roll over plans and all that kind of stuff. And I don't want to get really into the weeds of it, but let's just say like maybe I open a traditional IRA and then I come to you and you decide that like a Roth is better or a solo 401k is better. How does that work? Do we open a new plan? Can you transfer your money? What does that process look like?
Yes. Typically, it doesn't matter what you've done in the past. You can always just open a new plan. Now, again, a lot of this is geared towards people who have their own businesses, which is great because it allows you a lot more flexibility. You can really custom design a retirement plan for your business. So assuming that's the case, whatever you have in the past, whether it's IRAs, Roth IRAs, you could have 20 different accounts. It's not going to prevent you from opening up a new one. Now, you can't have two plans open in the same year, so there might be some timing issues, but it's best to start with what's the best plan for me going forward and then set up that plan, whether it's an IRA or a traditional IRA, simple IRA, et cetera. To your other point, Braden, of can you consolidate them? Yes, most of the time, any account that's a pre-tax account, so anything that's not a Roth IRA, essentially, can be consolidated. So IRAs can go into 401ks, 401ks can go to IRAs, simple IRAs can go to IRA. All those plan types can be consolidated together with no tax consequences or no penalties, which helps you to stay organized. And then you just kind of set up the best plan for you moving forward as well.
Gotcha. Okay. So the other question I have like a little mental list that I want to go through. We talked about the traditional versus Roth IRA, but can simple or SEP IRAs have Roth IRA tax treatment?
Good question. A simple cannot, a SEP cannot, a 401k can. So you can set up a Roth 401k. You cannot set up a Roth simple IRA. You can't set up a Roth SEP IRA. Both the simple and the Roth are pre-tax accounts, so like the traditional IRA. Now, what you can do though is if you set up a simple IRA and save $13,000 there, you can still also do a Roth IRA contribution at the same time. So it doesn't eliminate your ability to do. You can do a simple and a Roth at the same time, or a SEP and a Roth at the same time. It's not mutually exclusive.
And what was the contribution limit for the Roth IRA? Is it the same as the traditional?
It's the same 6,000. So that's the one. So in the way you could do that, if you wanted to max it out, you could put 6,000 in the Roth and none in the traditional. You could put 6,000 in the traditional, none in the Roth, 3,000 in each. Those are the ones though. It's a combined limit. So you can't do 6,000 to the Roth and 6,000 to an IRA.
And I'm kind of a policy wonk, so I always am thinking about the why that we have these rules, because then I think it's easier to remember the rules when we know why we have them. But I like to tell people the reason why we have these contribution limits is because the IRS doesn't want you to be able to put $100,000 into an account that can grow tax-free for 50 years. So that's why they put limits on it. It makes sense. Otherwise, wealthy people would find more and more ways to not pay any taxes.
Yeah. You get a great tax benefit for it, but the IRS is going to limit that tax benefit to a certain amount.
Precisely. Okay. So one more question I had mentally noted. This podcast is probably going to air. I'm not even sure yet, to be honest, but sometime between January and March, because we're batch recording them before the new year. but I know there's a rule about contributing money into your retirement plan after the new year and getting it retroactively onto your tax return for the prior year. So if I'm listening to this in February 2019 and want to lower my 2018 taxes, can I do that? And what do I have to do?
You can. If it's a traditional IRA contribution or a Roth IRA contribution you're looking to make, you just need to make that contribution prior to tax filing deadline. So April 15th or whatever the day is going to be in 2019. If it's a business retirement plan, so say a simple IRA or SEP IRA, the plan needs to be established by the end of this year, but you actually have until tax filing deadline plus extension to make those contributions. Now, that's not universal. There are some rules on that. So if you do have questions, I'm going to say that, cliche, consult your tax advisor, consult your whatever, but you have until tax filing deadline plus extension to get that money into your business retirement plan.
Beautiful. So I would tell people, if you're making a fair amount of money at a decent clip at this point, go talk to a financial planner. Now this is going to be retroactive, but if someone's hearing this towards the end of 2019, go talk to a planner before the end of the year to see if you should open an account. Mm-hmm. But at a minimum, what I tell people is, let's get your tax return more or less done in like February. And then if you have a $20,000 tax bill and you have X amount of money in the bank account, then we can use that information for you to go back and open your IRA once you already know what your tax bill is going to be, which is pretty cool that you're able to do that.
Absolutely.
Yeah. So what we do is, like, people will hire me. We prep the tax return. I say, this is how much tax you owe. Like, maybe you want to contribute some money into your IRA, and then we can put that on your tax return, hit the refresh button, and you'll be good to go.
See how much money you're saving in taxes and build retirement.
Okay, I'm sure I could come up with another laundry list of questions, but we got through a lot of really great information here. Is there anything else that you want to provide to the audience to kind of wrap up this topic?
You know what, honestly, Braden, I'm impressed if people are still with us. We talked about a lot of details today, so kudos to you if you're still listening. I think this was designed not to be comprehensive, because we could honestly talk about this for hours and hours and hours, but this was just designed to be an overview. Look, it's important to save for retirement, and if you're at the point where you're looking to do this, here's some simple ways to do it. Whether it's an IRA, a simple IRA, a 401k, these are just the tools to help you accomplish those retirement goals, and it's kind of up to you and your tax advisor and planner to determine what's the best one for you. Yeah,
I think my goal is that hopefully people got just enough information out of this to really get started and understand the lingo around these topics. I'm going to have this summarized in the show notes, and then I'll also be linking to James's website. It's rootfinancialpartners.com, correct?
Correct.
Okay, perfect. And then I would encourage you all to check out James's website, because I checked it out earlier today, and he has a lot of really good blog content on there on these topics, explaining things like Roth IRAs and how they work. And then if anyone was interested in talking to you more about your services, how should they go about that?
Probably the easiest way is if they're on my website, there's simply a set up a call link, and people can just get a link to my calendar, find a time that works for them, and I'll give them a call. If they want to shoot me an email, my email address is just james@rootfinancialpartners.com. But I would say go to my email. You can go to my website and just schedule a call directly from there.
Terrific. Okay. All right. Well, thanks so much, James. I really appreciate it. And I look forward to chatting with you about finances more in the future.
Sounds good. Thanks for having me, Braden.
Yep. You got it.
Bye-bye.
Okay. That was awesome.
Great.
Yeah, great. I think we went through all of that. I noticed like halfway through we were talking about the different types and when you should use each one of them kind of simultaneously, but I think it worked out really well that way.
No, I think good call to skip over step 4. Otherwise, you really would have lost people. Okay, we're going through it again. So I think you did a good job kind of monitoring all that.
Yeah, well, I was just organically like letting my questions pop up as they had them, because I've looked into all of this, but like 2 years ago. So a lot of it was kind of a refresher. I forgot what a lot of the contribution limits were. It's kind of fun. I always get kind of refreshed on this during tax season when I'm doing tax returns. Yeah. And then I don't really talk to my clients about it in the off season. So then it kind of pops back.
Yeah, no, yeah. It's just good to know kind of top of mind. What are the limits for all this? But yeah.
Totally. Okay, nice. Well, I'm hoping as my business starts to scale and grow, I'll have some people to send you during tax season.
Cool, man. Awesome.
Because I'll start to have, I'm like starting to talk to clients who are ready to form S corps, which is usually like $70,000+. And at that point, they, obviously need to start planning for things.
Exactly. How's business going for you?
It's pretty good. I actually, I really started like last May, June. So I was like half the year last year. And it was like, I'm probably actually going to talk to you about my finances at some point. So I might as well start now.
Happy to chat. No problem.
But last year I only made like $15,000. So this year I'm at least going to triple that.
Great.
But I'm shooting for 6 figures in 2019. So
that's awesome, dude.
Trying to scale it up quickly, but out of that 6 figures, I'm hoping to get like 40 to 50K just during tax season.
Okay.
Because my goal is like 50 tax returns at an average of like $500 to $700.
Yeah.
So.
Yeah. That's great. Are you finding most of your success through like Instagram marketing or just through friends you have or just a little bit of everything?
Instagram's actually picked up a lot for me in the past couple months. But like, have you heard the rule of 7 contacts? I was just talking to my friend about this earlier.
I don't think so. Oh, they have to see you 7 times to reach out or something?
Yes.
Yes.
So the traditional rule is like once you meet someone 7 times, and I have this philosophy of like, I call it like 100 touch points or like 1,000 touch points. And it's like each Instagram post that they read is like 1 touch point. Whereas if they meet me in person, that's like 100 touch points.
Yeah.
If they listen to a podcast, it's like 25. But once you get up to 1,000, so there are a lot of people that have been following me now for a while who they'll like engage for like 3-4 months, and then they finally reach out and like want to hire me for something. So
that's great. Yeah, you do a good job with Instagram. You're definitely on it. Yeah.
Yeah, it's a long game thing, but that's like my primary touch point.
Well, with the audience that you said you're kind of focusing on, it's perfect.
Yeah, they're all already there. So the idea of the podcast is to like reach people beyond Instagram, obviously. Yeah. And then YouTube will be the same kind of thing.
Yeah, that's awesome, man.
Yeah, I think it'll be good. Are you going to be at the meetup next Wednesday?
I will be there. I'll be there. Okay, looking forward to it.
I will see you there.
Awesome, man. Well, thanks for having me. I appreciate it.
Yeah, thanks again. It was really awesome. I'll obviously let you know when I'm getting this launched. So, you'll know about it.
Yeah, let me know and I'll send it out to my network.
Okay, perfect. Have a good day.
All right, see you next week.